My question is, what is equity, what is debt, and what is CCPS?
So guys, I think again it's a bit of a, I would say, a compliance or a legal term. I will take this up very quickly. Equity is something like what I just described, like it's like sharing the ownership of the company. Like founders hold 80%, employees hold, for example, 10%, and then seed investor hold 10%. So that is what they hold in way of equity. That is something I think people are exploring that in the startup ecosystem. There are some good I would say pros, I would say benefits of taking debt. Okay, let me just put this point out. If you are a B2B company, either a marketplace or a SaaS company, and you have a good revenue model, if you have achieved that milestone of 50 lakh as a revenue ARR, I would rather say explore option of venture debt rather than venture equity. Okay, because this will give you a leverage, a necessary lever to enhance your growth. Once you raise the debt, venture debt, it won't dilute you from the equity perspective. And once you grow your business to a larger extent, for example, once you become a company with a turnover of 10 crore, then you can garner much, I would say, lucrative valuation. At that time, you can garner a valuation of 100 crores, 200 crores. If you want to study how Jio has been built on this model. They have leveraged their balance sheet to a large extent because Reliance has that kind of an exposure to capital, debt capital, as well as the capacity to take that kind of a risk in their balance sheet. So they have made Jio a success, and now they have diluted only 20% of the Jio for almost 1.5 lakh crore of funding. 1.5 lakh crore of funding, right? It is not a joke. Like a $20 billion of funding just for 20% of the company. So it means Reliance Jio is valued at $100 billion. So I'm not saying you will become Reliance Jio, but what I'm saying is you can just get some speed up in your business with the venture debt. Once you build the company, if it's a B2B company, you're taking revenues, do not think of diluting your equity at this point of time, because equity for you will be a costly affair, I would say, right? So explore venture debt option. There are investors who talk about venture debt, and there are models venture debts are done. I think Ashutosh, please guide us on use of mezzanine equity. Okay, well, I think Ashutosh will not take on this particular, even there is a mezzanine debt kind of an option, which is like a priority over the traditional equity and the traditional debt. So it is like doing a sequencing or a classes of debt, right? So we'll just skip it for now because it will become too complicated for an entrepreneur. I can understand, consultant can understand those kind of a term, but for entrepreneurs, it will be too complicated for now. What is CCPS? So CCPS is compulsory convertible preference shares. This is okay. So this is quasi equity, I would say, because it does not give equity upfront to the investor, but it promises equity at a defined valuation in the future period of time. So okay, give you a practical how it happens. Any seed investor, any venture capital investor, even a private equity firm, when we go to the company and invest in the companies, we subscribe for the CCPS, compulsory convertible preference shares. There are a lot of reasons for that, because those are legally a different instrument. Those instruments are superior than the equity. They are above in the priority, and then you can attach a lot of conditions to the CCPS, and then all that stuff you can do. But for entrepreneur understanding, when you're getting investor, they'll talk to you CCPS. Just understand CCPS as equity, as simple as that. Compulsory convertible preference shares and compulsory convertible to equity, right? And last is convertible note. I think somebody has talked about the ECB. Let me just move on to the next slide. I think convertible note is something I would say a structured ECB, external commercial borrowing model. External commercial borrowing for entrepreneur understanding is when you do a borrowing but from outside the country. This is called external commercial borrowing, and RBI get involved in this, and there are tight regulations on that. So convertible notes are nothing but a kind of an ECB. It is a debt instrument, not an equity instrument. It is specifically designed for startups which are DIPP registered. So make sure your startup is DIPP registered. It's a lucrative avenue, as I'm saying. If you're a B2B company earning revenues, explore option of raising debt rather than equity. and these debt come collateral free. So don't worry. You need not to hypothecate your property or personal property with them. It comes collateral free, right? And with no, mostly you didn't need not to pay any interest or maybe very marginal one. So it's a debt instrument, but the minimum investment per investor is 25 lakhs. Maximum, okay, so this convertible notes either get converted or it can get redeemed depending upon the option of investor and depending on the agreement between the company and the investor. But within 5 years, right? Within 5 years, either it has to get converted and, or it can be repaid. Pricing guidelines, okay, put this simply, convertible notes are debt instrument. You need not to value your startup when you are raising convertible notes. A big relief, I would say. So if you do not want to go into the valuation at the seed stage because that's complicated, difficult to negotiate, difficult to convince, difficult to get convinced yourself, then do explore convertible notes or venture debt if you're raising within the country, or convertible note when you're raising from outside the country as an option to raise the money, right? And then it could be repatriable, that is something legal, just forget about it. Let's move on to the last question, Mohit. I think we are left with very less time.